You are probably wondering why this channel is discussing the 1929 stock market crash and the Great Depression. Long story short, you must know your past to understand the future.
The stories and iconic images of the personal hardships of that time are still familiar to many of us.
The collapse of banking and sweeping poverty.
Many economists have researched and dissected the 1929 stock market crash and all that followed. There are several ways the 1929 stock market crash could have been prevented. There are also several signs that some type of pullback was imminent during the 1920s. When the times are good, we start to think the bad times are gone forever. But in reality, this is not how the stock market works. Another reason we are discussing the 1929 stock market crash and the Great Depression on this channel is that the United States that came out of the Great Depression was way more powerful and capitalistic than the United States before the Great Depression.
The United States was in the fetal position, and people really wondered whether we would ever get out of this.
These changes in the U.S. economy give you the power today to start any business you want to start, just because you want to. And that is what this channel is here for, to help you hustle and find business opportunities to create wealth for yourself and your family. The best way to do this is through passive income. One of the best sources of passive income is through long-term investments in dividend stocks. Many people tell you that the Great Depression started with the stock market crash in October 1929, but that isn't totally true. Before the 1929 stock market crash, the U.S.'s underlying economic conditions weren't all puppy dogs and rainbows. The 1920s featured large-scale domestic consumption of relatively new consumer products, which was good for the American industry. But much of this consumption was fueled by credit and installment buying, which was unsustainable as it turned out. Other signs of economic decline appeared throughout the decade. Like by 1925, car manufacturing growth slowed along with residential construction. Farms were being foreclosed on, and worst of all, there was a lot of speculation in the stock markets during the 1920s. All of these factors and others led to the Great Depression. Just as in today's stock market, you can only expect but so much growth before a pullback is imminent. For 9 years, the stock market had climbed, increasing sixfold from its level in 1921, and the relentlessly upward trend made investments look like a sure thing. By 1929, commercial bankers were loaning more money for stock market and real estate investment than for commercial ventures. Hindsight being 20/20, you can all see where this was headed. But let's keep on keeping on. Investors weren't the only ones borrowing money. Easy loans and installment buying had fueled the economic boom of the 1920s. Businesses took out loans to expand, families bought new household goods and home improvements, and you could purchase a new Model T in installments, creating a massive boom in auto sales that in turn fueled the American steel, glass, petroleum, and rubber industries. So how did Black Thursday actually start off?
The following morning, the fear turned to panic, and brokers began unloading margin accounts at record speed, spurring the rush of sell orders from terrified speculators still more.
The sell, sell, sell shouting started right after the opening bell. This panic became very infectious very quickly. Just minutes into the trading day, the market loses more than 10% of its value. So many trades happen so fast. The stock ticker that brought the market real-time to traders across the country couldn't record the wild fluctuation in price, meaning stockbrokers in Chicago and California were trading based on prices that were 4 hours old. By the closing bell, the market only lost a little over 6 percentage points. By the end of Black Monday, just days later, the Dow had lost almost 13%. Black Tuesday was when this was all but official. A total market crash. People are getting into fistfights on the trading floor. Everyone is selling, but no one's buying. It keeps going down and down and down. Traders look at each other, trading slips falling out of their pockets. Some are now so worthless, they leave them on the floor. The market has dropped more than 20% in 2 days and would keep dropping. The Dow entered a steady descent that would not hit bottom until mid-1932. By this time, the Great Depression was in complete form. This is one reason many say that the stock market crash of 1929 didn't cause the Great Depression, because the crash finished smack dab in the middle of the Great Depression. I personally say they are greatly intertwined. Some aspects of the market crash intensified the Great Depression, and some elements of the Great Depression may have slowed down business, leading to weary investors. So, car manufacturing slowed, residential construction slowed, farms totally went out of business. These are all resulting in job losses. Now, these public company stock prices are falling, resulting in more layoffs. But now, in our new debt-based economy, these loans for buying stocks on margin are coming due. These loans for new farm equipment are coming due. That loan on your new Ford Model T is due. But guess what? You were just evicted, and you don't know where your next meal is coming from. So, when you earn $1 or $2, where do you think it will go first? Will you pay on the now worthless stock debt? Or will you purchase food for your family? Yes, food for your family. What made the Great Depression was massive unemployment and accompanying hardship. As stated earlier, we said that it was not totally true that the 1929 stock market crash started the Great Depression, but it did add fuel to the fire. The closest single cause of the Great Depression might be America's weak banking system during the 1920s. The Federal Reserve System had just been created in 1913. The vast majority of America's banks were small, individual institutions that had to rely on their own resources, unlike today. When there was a panic and depositors rushed to take money out of the bank went under if it didn't have enough money in reserves. So, in 1930, a wave of bank failures began to spread through several states. Banks had to call in loans and sell assets. This meant that credit froze up, and a frozen credit system meant that less money was in circulation, leading to deflation. So I hear you saying, I thought inflation was bad, not deflation. Deflation can be much worse than inflation. When prices drop, businesses cut costs, mainly by laying off workers. These workers then can't buy new goods and services. Inventories proceed to build up, and prices fall further. Banks aren't lending money, so employers can't borrow money to make payroll to pay their workers. More and more businesses go bankrupt, leading more and more workers unable to purchase the goods and services that would keep those businesses open. Guess what this did? Unlike today, where our money is FDIC insured up to $250,000 per institution, this was not the case back then. If a bank went under, you lost your money. So even those people not investing in the stock market were being hit, and hit hard. Another difference between then and today, the rich were being hit just as hard. Today, we hear how the rich are getting richer through each pandemic, recession, or depression. This is for several reasons. Many people have learned from the past and know what signs to look for as it relates to a growing or declining economy. The best reason for the rich getting richer during adverse events is because of innovation. Today, we are planning for the next catastrophic event. The rich are investing in these companies. New products and services can be created overnight. The rich don't get richer by shoving stuff in your face that you don't need. They do this by taking care of a need first. If an economy is shut down, how do you get food and supplies? Amazon delivers. If you are indoors more, how do you get Netflix and YouTube delivered to you? Through Amazon and Google's web services. These services may be too big for you to ever create on your own, but what can you do to take advantage of these worldwide changes? When the stock market crashes next, will you have $5,000 or $10,000 waiting to invest in great companies at a great price? Or will you let this once-in-a-lifetime event pass you by? The rich do not allow these times to pass them by. As we move to more online businesses, what can you offer online that is revolutionary? What will help you make it through the next recession or depression, even if you lose your primary source of income? These are things that you need to be asking yourself now. These are the things that you must put into action now. Rich people think ahead mainly by looking back at our past. We will always have health pandemics. It is just a part of the globalized world we live in today. What else do you foresee us having to deal with in the near future? Global warming? If you can't create a company like Tesla, maybe you can invest in a company like Tesla. Opportunities are all around you. You just need to know where to look, and to look back at our past is a great first step. Now, back to the Great Depression. Many people say that the Federal Reserve was the cause of the Great Depression. I mean, some of the steps and policies we have in place today to slow down recessions and depressions were in place back then as well. The Federal Reserve does deserve some blame for not rescuing the banks and not infusing money into the economy to combat this deflationary cycle seen during the Great Depression. The Great Depression became a worldwide depression due to more debt being added globally in the form of reparations. Britain and France owed the US $10 billion in reparations, and Germany owed more than $30 billion in reparations, mainly to Britain and France. To pay these reparations, Germany had to borrow money from American banks. But by this time, American banks were doing very poorly as credit had dried up almost completely. This had a negative snowball effect and spread the Great Depression throughout the entire world. Goods that were once being sold across the globe were now only being sold domestically. Several of the businesses trading their stocks on the American stock exchanges were international companies. So, you can see how this made the situation in the US much worse. Today, in the world of finance, we often forget the tragedies of the past. Yet, valuable lessons are to be had by exploring their causes and effects. After all, in a world of ever-changing rules, products, and services, history is the one constant that can guide us through the ambiguity. It's important to remember that the stock market isn't the same thing as the economy. Follow and stay ahead of the trends and invest in the future. Invest in your future. Stay educated and learn about these new technologies. The more you understand these new areas, the sooner you can become an investor. Just think about knowing how big Amazon and Microsoft would become, and you invested in them during their infancy. You have that opportunity today with new companies doing new things. Learn from our past to set the path for your future. If you're still here, thanks for making it this far in the video. I hope you enjoyed this video. Please check out the links below. Don't forget to like, subscribe, and press the notification bell, as it will help out this channel a lot. Check out one or both of the videos listed here on this page. And as always, learn more, hustle on, and power through. Thank you, and see you all in just a few minutes.